Hi, this is Bill Murrow with Make a Difference Business, and we're here today with Brad Kuluris with Gadfly Growth Strategies, and we're going to be talking about business estate plans. Brad, welcome. Thanks for joining me.
Pleasure to be here with you today, Bill.
So tell us a little bit about your background, Brad. I know you've been in business for a year or two. What's the journey been?
Well, as you say, it's been probably a decade or two or three or four. Been in so many different types of businesses, but the majority of my business has been in the retail business. But a lot of time in the executive side of it, working with large organizations, Fortune 50 companies, as well as small enterprises, and particularly more recently with nonprofits. So that's been kind of my journey.
Fantastic. So we're going to explore today, Brad, the notion of, what should a business owner do to prepare for their transition? Whether they're, selling their business this year, or maybe they're looking at 2 to 3 to 5 years, or even longer. The preparation for that is important because something could happen at any moment where you'd need to implement that plan. And this, of course, is if you're going to sell your business or pass it on, or even the notion of an employee stock option program. So we'll talk about all of that. But let's get into first today, Brad, the notion of doing due diligence and the concept of a business owner doing their own due diligence on their business rather than just letting the potential buyer do the due diligence. So why would you recommend that a business owner do that?
Well, as you look at due diligence, really what the potential buyer is looking at is your strategic plan and your business operation plan. Really, the due diligence that you see here is about good business practice, good business strategy that you would already be doing in any time during the time of your business.
Okay.
So when you're going to go ahead.
No, I was just going to say, so again, really, this is not like, oh, we're starting a project about our business from scratch. We're just kind of polishing up what we should already have in place in a good and effective business. Absolutely.
This is a wonderful checklist to look at your current business practices, your current strategy, and making sure that you've dotted all the I's and crossed all the T's.
Fantastic. So let's go ahead and dig in a little deeper. We're going to look at each of these 12 areas that you've described, external due diligence and internal due diligence. So the first place we're going to start is with the notion of doing economic due diligence. And clearly here, looking at the macro economy, what's happening with your customers, your suppliers, your people, the cost of money. What's your work like with clients in this area, Brad, and why is it so important?
So many of the clients I work with are in, I'll say, service industries or in heavy labor-intensive industries where the frontline workers require a lot of supervision and management and create a lot of training and hiring opportunities. Therefore, a lot of these business owners who spent 10, 20 years very focused on what makes their business run, not the environment in which their business is running. So this really takes an opportunity for you to take an external look. In a publicly traded company or large organizations, we would say that a CEO's focus was probably 60, 70% external. Many times we find in these blue-collar centric or service-oriented businesses that maybe 95% of the CEO's time is spent internal instead of external.
So do you, in your work with them, does the business owner find this kind of analysis difficult, or is this something that, again, they have the data, it's just doing the deep thinking and the analysis about it?
Many times it's an acquired knowledge and intuition that they work with in their business. They may be in the construction industry, for instance, and see indicators that there's a downturn coming. They may not be able to put it into, I'll say, data-driven decision-making tools, but they kind of know things are slowing down. People aren't returning their phone calls. There's a glut of supplies or things. So what this does is really create a little bit of a some dialogue and some data-based information that helps them look at their business in a deeper level that maybe they've done before. Not to say they aren't already thinking about these things, but they might not have the rigor that we would look for in a strategic plan or a due diligence for a seller.
And surely, we're talking about people who are considering, turning the page, moving on to the next chapter in their life. They've been through the ups and downs before to get to this point. So it's not like, again, this is foreign analysis to them. They've been there, done that, got the holes in the t-shirt.
Right, and many times, for instance, a client of mine's in the construction industry doesn't have a high school didn't graduate from high school. If you asked him what macroeconomic indicators are out there, he couldn't tell you. But in the dialogue and the conversation with him, he could articulate what I would call those macroeconomic indicators in ways that I could understand, translate into helping him create a document that could be useful for someone that might be more sophisticated or a lender that might be involved in a transaction.
Fantastic. Clearly an area where, a mentor or a guide for the process is just invaluable to the business owner. So let's go ahead and take a look at a second area of due diligence. And here's a fun one. Let's look at regulations. What's impacting your business? There's so much regulation in all of our businesses today, and how could they impact your business? So as you work with business owners in this area, Brad, what do you find their comfort level, their understanding, and then their analysis and strategies around dealing with regulations?
Yeah, I find that a lot of times business owners are pretty aware of the negative impacts of regulatory regulations on their business. It might be labor, it might be the way it costs, because of a government program, they have to cost it a certain way. But many times they're not looking at the opportunities that show up because of a change in the regulatory environment. And this is where, again, that external focus helps. Many times the internal focus is I've got labor issues, minimum wage just went up, or I now have to pay for this healthcare program. So they realize the negative impact of those regulations, but they may not see, well, now we no longer have to pay a tariff on this particular product. There's an opportunity for me to get into this new line of work.
I'm so glad you framed it that way, Brad, because I think you're right. The notion of looking at the downside of the government's involvement in our lives and our business life is paramount for us, but we don't really look at that other side of the coin. We have a strategic partner who has work that they do in the R&D tax credit area. So this is an area where the regulations can actually play to the benefit of the business and inject cash into it.
Absolutely. Look at the whole solar industry,
Mm-hmm.
where we were seeing tax credits and subsidized assistance, where whole industries would take off because of a regulatory change, knowing or following the legislative process, either through maybe a trade group or industry group that you have, or through lobbyists, and that can help you position your business to take advantage of that shift.
So maybe Reagan overstated a little bit. The 9 worst words to hear is "I'm from the government and I'm here to help." Maybe sometimes they are.
Well, there are many a folk who made a small fortune off of a change in regulations.
Very good. So let's now talk about the market. Now, this is something that business owners, must really have their finger on the pulse if they've reached this stage where, their business is perhaps positioned for sale. So how do you help them in this whole market analysis, Brad?
Well, and this is certainly the key to positioning your business for growth is understanding what markets you're in. Many times people have too narrow of a definition of what market they're in. I'll take you back 100 years when the railroad industry looked at themselves as fixed rail transportation companies that move product along a fixed rail line. They didn't see themselves as moving people and moving product as their core business. They saw themselves as trains and tracks.
Yeah.
They missed an opportunity to get into the airline industry or into the trucking industry. Another great example is Sears and Roebuck at the turn of the 1900s. Everybody had a catalog that was 3 inches thick of pretty much anything you could possibly manage that you could buy. However, eventually Sears and Roebuck lost all of that, if you will, market to Amazon.
Mm-hmm.
If they would have changed that thinking from the catalog to the internet, they'd be Amazon today and not going out of business.
That's for sure. And this particular slide strikes me, going back to one of your original comments, that this is just good business for people, whether they're thinking about transitions or not, to be doing this kind of analysis, this kind of study, this kind of deep thinking about their markets.
And particularly the last, an area a lot of people don't think about is, in competitive strategy is, what are the barriers to entering your market? When you come out with a product, or you've been selling or serving a particular way over a decade, sometimes the cost of that particular service or that product has gone down, that almost anybody could be your competition. Now you have to re-erect new barriers, or it could be in trademark or copyright. It could be in particular manufacturing processes, but we need to constantly be looking at, shoring up our business, our industry, to not make ourselves easy to be replicated or to have our intellectual property copied.
And it's just fascinating when you think about, you don't need to be, leaps and bounds better than your competition in this area. Just being a little bit better in every area can really add up and create some separation.
Absolutely. And the other concept that's really I would say not thought of a lot is the whole idea of targeting your different sectors in your business. One of the I think one of the really great brands out there, and this in the hospitality industry, is the Marriott brand. Mm-hmm. We all think of Marriott as a Marriott Hotels, and as they got into more budget hotels, they created the Hampton Inns, per se, or the Courtyards. Mm-hmm. They would always title those, Hampton Inn by Marriott. But did you know that Marriott also owns the Ritz-Carlton? Rarely do you see the Ritz-Carlton by Marriott.
Yeah.
You wouldn't even know it's owned by. So Marriott's segmented the market into these areas, and based on how their clients, their customers see them, they market to them differently, even though they're all under the one umbrella and they have the benefit of buying and back office efficiency of being a large brand.
I think that strategy's worked out pretty well for them so far.
They've done pretty good, yeah.
So now let's look on the other side of looking at your market and look at who's also looking at your market and your competition. So if you can think of, Brad, somebody you've worked with and, that they were facing struggles with their competitor. What's the story you could share about how somebody perhaps has approached this competitive analysis and discovered that differentiation that helps them win the market?
Well, I think of, we'll say this in the food industry, for instance. McDonald's hamburgers, for instance, a national chain, the largest restaurant chain in the world, always serve coffee. They serve coffee, cream, sugar, right? Sweeteners, and that was it. Mm-hmm. And when they had a new competitor show up in the marketplace, that one with the green label, it was at the Starbucks. Yeah, when they showed up on the scene, all of a sudden, they took a piece of McDonald's breakfast business, certainly their beverage business, even though they charged a much higher price point. Eventually, what we saw was McDonald's response to that was the creation of the McCafe, which is really a little kind of Starbucks type of a setup within a McDonald's. Mm-hmm. And today, they are a lower cost alternative to Starbucks through their distribution channels, but it's a highly profitable part of their business. They're not quite as expensive as Starbucks. They found that middle ground, but they open up a whole new area of their business by paying attention to what the competition initially hurt them with.
So sometimes it takes a new competitor really disrupting the industry to kind of give you that wake-up call that a burger and fries with that might not be the answer all the time.
That's right. I think we all sometimes cringe when someone kind of comes into our space with a clever idea or a lower price point. But really, it's those opportunities that allow us to sharpen our sword a little bit, allow us to retool and think differently. And that's what keeps us growing, by the way. If we didn't have that competition, we'd become complacent. Many businesses have become complacent. Remember Montgomery Ward's?
Oh, yeah.
Where are they today? And so we've seen a lot of very large enterprises disappear because they just figured things were never going to change. We will build it, they will come. And at some point, if they don't keep reinventing themselves, they no longer come.
And I know we've given some examples of Starbucks, McDonald's, Montgomery Ward, Sears, some large franchises and large enterprises. But really, this is any business needs to have that. I'm going to call it nimbleness to be conscious of how they claim their position.
Yeah, you could look at here in Phoenix, we have a very competitive heating, ventilation, air conditioning market. It gets to be 110, 120 during the summer. Air conditioners are kind of an essential thing in our marketplace. So there's quite a large competitive set of contractors that take care of air conditioners. And every year we see a new competitive set of things they're doing to win over their customers, to create loyalty. It might be a preventive maintenance program. I heard on the news or heard on the radio the other day, one of our large vendors talking about this dog that offers this monthly program. It sounds like an incredible price to take care of your plumbing, your air conditioning, but they charge you monthly. It's a subscription business, as opposed to when your pipes get full, your air conditioner goes down, you've kind of prepaid for it. You're paying for it on a subscription basis. So again, it's shifting, thinking differently than their competitors are. Instead of just lowering the price on a service visit, they're saying, why not convert it to a monthly cost and then service them better when they need help?
Well, what a great example of how to disrupt the market and by doing so, creating loyalty and customer retention, and I'm sure increased revenues and profits as well.
Predictable revenues, yeah.
Yeah. So let's talk about the supplier side. I'm just going to venture that maybe business owners don't think about this as much as they do some of the external things where they're reaching out to their market and their customers. What's your take, Brad? How do people tend to do the deep thinking about their supplier relationships?
Well, many business owners that are at this stage where they're talking about selling their business, handing it over to another family member or a key member of the executive team, they've been in business probably 20, 30 years. So they've got, I'll say, established suppliers. And many times we don't think about pricing, service, or even risk. Recently, we've all seen the disruption of the supply chains in the food industry, or even, shall we say, toilet paper. Mm-hmm. When all of a sudden, the consumer buying practices change, and all of a sudden you can't get what you need. Or it has to be shifted. For instance, we've seen a shift from meals eaten out to groceries being purchased in a grocery store. So all of those meat products or bulk vegetables or bulk sauces and things that were being manufactured for takeout business, 50% of the food industry, have now had to shift almost on a dime to smaller packaging, going through distribution channels they don't have set up. And we're still going through it, where they're shifting to this consumer-based distribution channel as opposed to a business-to-business distribution channel. So having backup or alternative supply chains is important. Even look at the manufacturing we see from China. Getting things like masks, for instance. We got down to where it was really 3M was the only supplier of a particular mask, and most of them being manufactured in China. All of a sudden, we can't get them from China. We don't have them here. So having those forethoughts about your supplies is really critical.
Yeah, the other thing that strikes me, what you kind of opened up this particular segment around, Brad, is, so I'm a business owner. I've been doing business in my community for 20, 30 years, and I've probably had relationships with my suppliers for 10, 20, 30 years. Well, guess what? That supplier may be ready to transition as well, and you got to have
Yeah.
new relationships. So how do people, again, think forward to making sure that they're protected in case maybe your supplier retires before you do?
Yeah, and that's an ongoing, as we talk about external focus, having those business relationships and having those connections outside of your day-to-day operations is so critical. So that owner or that key person in your supply chain, and that they're in the same business cycle that you're in terms of thinking about moving on, and you understand that they have a succession plan in place, or that it's professionally managed. So whether the ownership changes or not, the supplier will still be there for you. So it never hurts to do a little bit of due diligence on your supply chain and really make sure that they're capable of growing the way you're growing, or have minimized the risks that, as you're looking at minimizing their risk with them, they look at the risks that, they might support or create for you.
Yep. Clearly, just good business to look at that side of it as well. So I think this is our last area. We're going to look at the external side, Brad. So we're going to talk about customers a little bit. And again, you would think that any business owner, has their finger on the pulse of their customers and their customer relationships. But would you say that's true as they're looking to transition, or is it getting a little shaky then as they're, looking to exit, and maybe some of the customer stuff gets not as much attention as it did in the past?
Well, it could go one of two ways. Many times people actually resist transitioning out of their business, even though it's time, because they feel an extreme loyalty to their customers or to their clients.
Sure.
And they may stick around way longer than really recommended because of that situation. And the other is, they get tired of dealing with their customers. They've been doing this for 30 years, and I'm burned out trying to smile and take care of these people that are not appreciative in that. So I say both are true. Again, if you, as the owner of the business or the leader of that business, have a culture that is centered around satisfying those clients and those customers, then you're going to be in a much better position, because the value of your business will be better. That it's not dependent upon you. You, as the CEO or the business owner, the leader, create the culture in which these things happen. And so if you've done a good job of that, when you leave, that will continue on. And that makes the buyer, or even the people, it might be your family members that continue the business, it makes it really a smooth transition, because disrupting customer service or disrupting that customer relationship can probably cause more pain or more harm in your business than just about anything else.
Yeah, I'm just, thinking about this as you're talking, that if I'm, say, in the construction business, and again, my supplier relationships are, many, many years and decades that they've been built. And frankly, I may have customer relationships that are the same. I've built for the same customers for years. And here comes a buyer and you're going away, and it's like, do those relationships go somewhere else, or how do we make sure they stay with the business?
Yeah, and this is a real a reason for many professional organizations, doctors, dentists, lawyers, CPAs. One of the reasons that their businesses sell at such a low multiple of EBITDA, of cash flow, is because many of their customers, clients, patients are loyal to that professional, not to the business. So when you sell the business, you tend to be buying assets and maybe some goodwill, but certainly not the customers. Those customers have to be won over by you, the new professional. So whereas in a retail environment or manufacturing environment where there's a system that's not necessarily related to one person, those having good systems and good processes can keep that value there for your transition.
So the implication is again, if you're thinking ahead, you're planning the transition, and your customer relationships are kind of one-to-one, you need to be working on some strategies to make sure they stay with the business, because it's going to have a multiplying effect on what you're able to sell your business for.
Right. In law firms that bring on the junior partners, that junior partner begins to go on the client calls with the client they've had for 30 years. Or a dentist, hires a younger dentist who's now going to be working there and seeing some of the ongoing clients occasionally and being introduced. So yes, mentoring that successor is really critical. And the same thing with salespeople, taking them out there, the new person maybe breaking up or moving around sales territories. There's so many ways of making sure you're not reliant on one person to make sure your business is successful.
So we've covered an awful lot of ground already, Brad, in just exploring the external due diligence that any business should do, and certainly as they're preparing for transition. But now we're going to start looking inside the business and looking at what you need to do to make sure everything's buttoned up on the legal side. Again, Brad, from your experience, do people tend to have this buttoned up, or it's where are those files?
Well, yeah, this is probably one of usually the biggest problems when getting ready to sell a business is, they incorporated 30 years ago. Many times the owners may know they're a subchapter S or C Corp or proprietorship, sole proprietorship, but they may not have the documentation. They might be a C Corp and they don't have their annual meeting notes or minutes. They don't have records of even what the stock certificates are. So this tends to be a really, takes some time to clean up. And the more complicated your business, if you have multiple layers of LLPs or LLCs, I'll say you get 50 locations and every location is set up as a separate LLC. Each has its own leases or, which makes total sense from an asset protection program. But in terms of having everything up to date and clear for the due diligence process, or if you need it for another reason, maybe you're going to change your capital structure, borrow money. A lot of times this information is not easy to get.
So clearly, pulling it all back together, getting your arms around, especially if you're selling it. You can't have these loose ends straggling out there. And again, we're just talking about the ownership structure. We're not talking about the variations on the contracts and do you have IP that you've protected? And heaven forbid, is there litigation in your past that you need to have addressed so that you can explain it away if it's out there?
And even on the positive side, absolutely. But on the positive side is you may want to change your structure.
Mm-hmm.
You may want to go from being a S Corp to a C Corp to take advantage of a particular tax advantage sale structure. Or you may want to pull the intellectual property or licensing out of your corporation, set it up as a separate corporation and maintain that after you sell the business, just like we might do if you were selling a storefront. You may keep the real estate in a separate LLC, sell your business, but be the landlord for the new owner. So yeah, many times you have to think about what it is that you want after the transaction to look like ahead of time, so you can structure your assets, your legal ownership, your goodwill, all these things in a way that make most sense for your next venture.
What an impact. So we're surely not just talking about getting all the folders in the same drawer of the file cabinet. This is really a strategy consideration that you need to think through and get the proper guidance on where are you and where should you go from here.
Absolutely. And so many times people just rely on their lawyer for this category, and really the lawyer documents and it may help you avoid the pitfalls and litigation, but the strategic use of this area is really rarely not. A lawyer's real good at this stuff, particularly as a corporate lawyer, been your lawyer for a long time. Many times you need someone that's got kind of a different picture of this that can help you restructure with your current legal counsel into a way that takes advantage of this transition.
Fantastic. So let's take a look at another area. Of course, the people. You know, we're not just talking about employees. We're talking about directors, advisors, contractors. You know, what are the benefits program? How are they performing? What work do you do in this area, Brad? And what do you find that business owners grapple with here?
Well, you know, again, it's about continuity. You know, one of the things that you want to assure whoever's going to take the business, whether it's family or a new buyer, or maybe it's a roll up to a larger organization, a merger and acquisition, you want to make sure that there's continuity here. And that's where having good policies, procedures, good annual review programs, you know, good benefits programs, all these things that are just good way of taking care of your most important asset, your people, that you want to have those in place. Because what you find many times when you start having people coming around, looking at things, asking questions, you know, maybe it's the business valuation people, maybe it's potential buyer, your internal people see that. They're going to start asking, well, it looks like he's going to sell the business. Oh, you know, they always put all new people in accounting when they do that. So
Yeah.
you run the risk of losing key people when people start seeing things changing. So you need to have those, you need to be ahead of this and be sure you proactively work with your people. And you've got programs in place that, you know, they're not going to leave. The management or the ownership doesn't really change how they do their work or how they are compensated or treated.
Well, I know this is an area, Brad, where you have some particular expertise in looking at the people and seeing if it's the right situation for an ESOP. Tell us a little bit about what you do to help people explore those possibilities.
An ESOP, which is an employee stock ownership program, is it's a program that's been around for in various forms for over 100 years. Some of the largest companies in America started off as basically employee owned, like Sears and Roebuck, UPS. Currently, Winco, a large grocery chain, is owned by the employees. But there's a tax advantage to the employees owning the business, and the government says because the employees own the business, which is a good thing, we're going to allow that business to operate as a tax-exempt organization. So think about that a minute. If we pay corporate taxes at 21%, that federally and nationally, and it's locally maybe 6 or 7%, you have a 26 or 7% decrease in your cost structure. How would that position you against your competitors in terms of the next bid you make? So when you sell your business, leaving your business to your employees, and that doesn't mean you can't sell it to your family, by the way, not your family. You can continue to control the business.
Mm-hmm.
So basically, you're going to, as the owner, sell your business to a trust that your family can still run the business and still be compensated as a CEO or the vice president of operations of that. But the employees in trust own the business, and that becomes their retirement program. And they make out very well from a pension, if you will, or a retirement program. You as the owner, if you structure it properly, can walk away and pay no taxes on the sale of your business. And you leave the people, the employees that currently run the business after you leave, with a tax-exempt corporation. The only other place in the IRS code where that happens is credit unions. And banks hate credit unions because they have such a cost advantage over them.
Well, what's amazing about what you just described here, 20, 25, 30% reduction in your expense structure and the advantage that creates in the marketplace, let alone what you added at the end about this is a tax-free sale of the business for the business owner. People should be looking at this much more often.
Well, particularly in the area of what you and I have been involved with this, we call kind of the blue collar culture, with these service oriented businesses, you know, plumbing, construction, even restaurants, hospitality. You know, many times there's great people in those organizations that built that business. They can continue to be in the business and be owners of the business. Or if it's a family owned business, your son or daughter can take over the business. But you don't want to just give them the business. You can sell the business then, cash out of your business, allow them to continue to operate the business in the style and in the culture that you wanted, and take care of the people that made you successful. So yeah, it's hard to envision the downside of an ESOP, but I will say that They are complicated,
Sure.
extremely complicated. They require a lot of hand holding, but they're no more expensive. They roughly run about 3% of the transaction cost, which is the typical cost of a business broker to sell your business for you. So, or an investment bank, for a mid-sized transaction. So it's really the same cost. It's just the money spent with lawyers instead of brokers and deal makers.
Mm-hmm. Fantastic. Let's look at another area. So doing internal due diligence on your own marketing. We looked at this from the market side previously, but now we're kind of looking at it, do you have everything buttoned up on the inside with your marketing and sales? What are your thoughts there, Brad?
Again, it gets down to processes, systems, and looking at your business strategically, internally, annually, if not quarterly. When it comes to pricing, so many times it's the tail wagging the dog. We see what our competitors do, then we react to it. Sometimes, if we're not organized around a review of these things on a regular basis, they could go by for years.
Mm-hmm.
And you kind of wonder why you've got all these customers banging at your doors and you're not making any money. Well, it's because you're underpricing the market by 30%. You're not, so you're giving away your product or your service. So it is important to review it on a regular basis and have a process for that review. And the other piece of this is the distribution channels, the way you distribute or sell or move your product or service in the marketplace. Constantly evaluating that. Again, we mentioned earlier, Sears and Roebuck missed an opportunity to continue to distribute those products they did through catalog sales through the internet, or the railroad business, missed the opportunity to be in the airlines. So, you want to think about the channels because they do change. The internet was a huge disruptive change. Look at what's going on today with many service businesses like that we would normally go into a place and pick it up or go consume it there or have it done there. Now it's being outsourced.
Yeah.
Take it home or so yeah, things are shifting.
That is for certain. So
always.
Here's another process area is, looking at your operations, your policies, procedures, processes. And again, I think this is an area where, just about any business has opportunities for improvement. What say you, Brad?
Yeah, this is really a huge area where many of us get lax. Writing policies, procedures, documenting the way things are supposed to be done, particularly when, let's say, Harry over here has been doing that same job on that press for 20 years. Why do I need to have a policy and a procedure for Harry? Well, Harry's not going to live forever, or you may want to capture what Harry's doing. So when you need a second or third Harry, we know how that works. There are wonderful people in our network, Bill, who spend a wonderful amount of time digging into this at a very deep level and helping you document and create processes that allow you to improve on a regular basis. That old concept of continuous improvement, Kaizen, if you will, the quality focus that after the turn of the World War II really moved the American enterprise as well as like Japan and Germany and much higher levels of productivity the world had never seen before because they were about incremental improvement. It's, the wonderful radical improvement's great too, but what if you do just a little bit better, those ISO 9000, make it redundant, make it perfect, or as close to perfect as you can.
I thought before about, people tend to think, okay, well, I know how to sell my business because I've sold several houses in the past. And it's like, okay, you put your house on the market, you got the MLS to compare. So maybe you can stage your house to look a little better and make a few bucks. But this is an area where you do some polishing of your business here and you start to take cost out of your structure. Again, there's a multiplying effect on what your sales price is.
Well, there's two numbers that really affect the value of your business down the road. One is that cash flow, right? So if you do these operational things well, you're likely to see an increase in that EBITDA, in that cash flow in your business. That's one of the numbers that's multiplied in value in your business. The other is the kind of the multiplier, which is the multiples they call it. And the more organized your business, the more clear it is what it does, the more smoothly it operates, the faster it grows, the more percentage of sales the EBITDA is. All of those increase that multiplier number. So you may go from a 2 or a 3 to 4 or 5 or 7. And then the other piece is when you're selling your business or moving your business, maybe as part of a merger and acquisition, is finding a strategic buyer. When you nailed these things and have actually a competitive advantage in these areas, sometimes you'll find a strategic buyer that's willing to pay you crazy multiples because they don't really, it's not the business, the revenue they're buying or the EBITDA they're buying your process.
Mm-hmm.
And so when you spend time in this area, many times you will attract a strategic buyer that will pay you crazy money. You see this in the tech world a lot today. Apple will acquire someone that's really has this innovative, really great software for speech recognition. Even though they've got Siri, they'll spend $1 billion to buy this little company that's got 7 employees that's selling $50,000 a month of software.
Mm-hmm.
And they'll buy it for $1 billion, not because that's the multiple of EBITDA, but because there's a strategic value that they've created by doing this stuff well.
Lots of opportunity just with a little bit of polish. Okay,
Yeah.
well, we're kind of touching on technology. Let's just keep on a roll here, Brad. How important is technology, frankly, in any business today, including our blue-collar businesses that we've been spending so much time focusing on?
Well, the technology has become a critical part of the productivity equation. In the old days, you've probably seen pictures in the 50s where you'd have a floor of, 500 people with calculators being the accounting department. With the advent of spreadsheets, we were able to eliminate some of those. And then as we continue with, augmented or artificial intelligence or, software that can kind of think critically about things. So it's what it's doing is allowing us to spend less of our resource on human capital in that particular area. Many people say, well, we're going to, lose people. I'd say that, many times it allows you an opportunity to redeploy those assets in a way that grows revenue instead of being a cost center. So technology implemented well can increase your productivity, increase your profitability. It can also, in terms of operations, create your processes so they're more hardened or less likely to be broken down because an individual is sick or screws up or does something bad. So technology can be a huge stabilizer in a business. Many times, people think about just the cost of it, but you need to really take a look at what it does in terms of replacing human beings and not replacing that particular human being because that person could be doing something else, but just helping you increase that stability in your organization.
Just one more game changer as a owner thinks about that transition. Just button it up. And here's the fun part, Brad. Let's talk about the financials because I think, a lot of people think, well, I do my P&L every month. I do my taxes every year. What else do I need to do? And really, if you're thinking about transition, there's a lot more to do. Tell us about this.
Well, and how we present this information. So hopefully you are, keeping good records. Someone is managing your general ledger, your accounts payables and receivables have a process. All this is feeding into a unified financial system, which you're looking at, on a monthly basis, cash flow, the balance sheet, and your operational statements. Those 3 statements, any business needs to have those to operate well. I find many times, a lot of businesses in the area we're talking about, they may be being done by the accountant, but the owner doesn't understand them or look at them.
Yeah.
I'd encourage business owners to really spend some time with their accountant, have them educate them as to what these things mean and why they're important. Why is a balance sheet important? Particularly when you're getting to, sell a business, that's a really important piece of your business. What have you built up there? Many times we're always focused on trying to decrease our operating profit, so I don't have to pay taxes. But that can have an inverse impact on your ability to sell your business at a higher price. I know a lot of mom and pop business, for instance, they don't necessarily report all their income. They think I don't have to give that money to Uncle Sam, right? The taxes. Well, then when someone looks at your tax returns when you're getting ready to sell the business, and you tell them, oh, well, I really make twice that, but my taxes, how I do that. Well, no, you've already sold your business to Uncle Sam a year at a time.
Yeah.
You're not going to get that money back at sale.
Yeah. And again, I think if you are at the point now where you're going to begin to engage potential buyers, you have to do this analysis. You don't want them to approach you and say, why did this happen? Why did that happen? Why is this wrong? Why is this too high? Why is this too low? You need to do the thinking and the preparation to have those answers to explain why you've done things. And it isn't just, hey, here's my financials, have a nice day, let me know if you have any questions. You got to kind of sell it as well.
Well, there's a strategic part of financials too. And we mentioned it earlier in terms of how you structure your business. So if you're going to sell your business 5 years from now, and the way you're going to have your lifestyle maintained in the future is you're going to become a landlord to all those businesses you used to operate. Mm-hmm. Well, you need to think about how you're going to begin to change those relationships. So you're going to create leases, for instance, that you're leasing your property from your other LLC at a market rate. So when you sell the business, you don't have to renegotiate the lease. This has got a 20-year lease. It's a market value lease. You know what your income is going to be from that asset. And so you've already baked that into the financials that the buyer sees. So you want to be looking at these 3 years is important, but those 3 years you want to have set up to be your best 3 years, right? So you need to be thinking about this. I always tell people, if you're going to sell your business, we need to be talking 5 years before that date happens. Mm-hmm. So we can spend a couple years getting those 3 years to be your best 3 years. You want your last 3 years as the owner to be your best 3 years.
That's fantastic.
And all of those statements.
So, Brad, before we wrap up here, clearly as we've gone through these areas of due diligence, there's a need for a lot of specialists. You're going to need attorneys, you're going to need accountants, you could need process consultants and things like that to help you. But really, the role you play with the business owner, Brad, is a little bit different. Tell us again exactly what you do to help people through this process.
Well, I like to say I'm a mentor or a guide. And many times you hear the term coaches or life coaches that look at your whole life and help you through it, which is really a wonderful thing. And that's a lot of what I help people with. But there's something very different about my experience in the average life coaches. I've been a CEO of a $50 million business. I've owned investment banking business. I've been a mentor to CEOs. So it's not that I've actually been there, done it. It's like if you want to go fishing in Alaska, you might be a really great fly fisherman up in the White Mountains in Arizona. But when you go up to Alaska to have your dream fly fishing expedition, you're not going to understand the bugs, the river flows, the particular tackle or gear. You're going to probably hire a guide to have the best possible experience that you can have when you take your dream trip to Alaska to go fly fishing. And that's much of what I do. I don't have a vested interest in the capital that needs to be raised or sold or the legal, or I'm not, as a professional, I'm being paid for those services. So mm-hmm. I can be a trusted advisor to you who's actually done this before. I understand, as being a CEO, being a business owner, what it's like to be in the shoes that you're in right now, and have been there, done that, and can help you through it. And I think that's invaluable, because let's face it, we can only take so much of this home to our partner or spouse before they don't want to hear it anymore. And they may not have the expertise to help guide you through this next phase of your enterprise.
That's for sure, although they certainly have an interest in you doing it right and doing it in time.
Yeah, as well as I will. And I tell you, that's the other thing, is having a sense of, preparing you for this next venture, with this next venture of your life. And for some people, maybe travel or sort of some of the missionary work, or it might be just, kind of taking it easy and being with the grandkids, whatever, or it might be starting a small business of a different sort that you always dreamed of, or buying a sports franchise, who knows? But whatever that next venture is, working toward that while you're looking at exiting your current one and having this planned transition, this planned succession, really can make a huge difference in achieving that joyful outcome you want to have in that, in that second half of your life.
Fantastic. So Brad, just in case we have anybody who's not watching our presentation here, but is just listening to it, how can they reach you?
They can reach me via email at brad@kuluris.com or on my cell phone, 602-763-2433. I work with a limited number of clients. And then also you can visit my website to give you a little more background on what we do, and at Kuluris.com.
Fantastic. Okay,
or
Brad.
Gadfly or something.
Yeah. Well, thanks so much for spending this time, Brad. I think this is going to be really helpful for people to pay attention to these topics, and hopefully they can reach out to you and take advantage of the great service you provide. Thanks so much.
Thank you.